tech stocks are getting whacked, volatility is spiking, and everyone is panicking. But here is the thing, I see opportunity. Today, I'm breaking down what's happening, why the market is tanking, and exactly how I'm using options to make money in this chaos. Now, if you want, you can jump to a specific topic of this video, but the first part, I'm going to talk about these stocks crashing and the VIX soaring and what this means. The other part, I'm going to talk about options, cash secured puts, and dollar cost averaging, and how I'm applying these strategies to make some money in this down market. And I'm going to talk about what's next, reciprocal tariffs, more volatility, and how I'm playing it. And I will conclude by sharing my thoughts and where you can follow me and even reach out if you want to talk to me. But before we dive in, quick disclaimer, I'm not a financial advisor, just a random guy who loves making smart moves in the market. So always do your own research and don't blindly follow anyone on the internet. Cool, right? Let's get into it. Now, let me first start by showing you what happened in the market on the chart on trading. So I'm recording this video on April 3 and just after market close, but you can see here that most of these, almost all these tech stocks, they have really dropped by almost 9%, right? You're looking at Meta, Amazon, Apple, Nvidia, 8%, Tesla, 5%, but Microsoft kind of like withstood this down market moves. But at the end of the day, you can see that the S&P 500 is down 4.84%, but the VIX is 38% up, signaling that all is not well in the market. What that means is that there's extreme fear in the market and a lot of people have been selling off. Hence, you see this down market. You can see here, if I look at this chart here, that the market has been on a downtrend, and this chart is on, it shows, like the time frame for a couple of months, and it's one chart here. It means what happened in a day. So you can see that the past 2 days here, the S&P 500 has dropped by 5.38% from this, right? Because let's say if you got in at this point, you would be almost 5% down. But the point is the market is on a downward trend. And let's see what causes this. Yesterday, President Trump and the Rose Gardens announced what he called the Liberation Day reciprocal tariffs. And now this is what has been happening in the market post that announcement. And there are some few other reasons that are even accelerating this situation. Number one, investor fear. The market is full of get me out of here mode. Like everybody, most people, they are kind of like, I want to get out and stay on the sidelines because I don't know how far this market will go down. Now, this brings me to the second point, interest rate worries. The Fed is keeping rates higher for longer, but now with this volatility and the tariffs, the Fed in the US has been put in a very difficult spot. In Canada, the Bank of Canada has already reduced interest rates in their last meeting. And what this means is that if the Fed doesn't reduce interest rates, it might cause some challenges in the economy, because now tariffs by their very nature, they are inflationary and they cause some challenges on the supply chain. Now, like I said, the third point was like reciprocal tariffs are possibly coming. I was watching TV on Bloomberg, and countries like Germany and the EU at large, they are indicating that they are actually going to retaliate these tariffs firmly. China is saying the same thing, but the countries that I think might be mostly impacted are the developing countries. You see, countries like Vietnam, they were slapped by very high tariffs. South Africa as well, they were slapped by tariffs. I was seeing on X a friend sharing that Zimbabwe, my home country, actually, they were slapped by 18% tariffs, reciprocal tariffs by the US. So what this means is that a tariff by its very nature is a tax. So it's a tax to importers. The idea is to encourage the domestic industry to actually invest back home and set up shop back home in the US. So what that means is that it might take time, but over the long term, this might be potentially a good thing. But higher costs, what they do is they drive the cost of production, cost of doing business. So companies like Amazon, Apple, which rely on international supply chains, they may be hit hard. And if this escalates, this could hit corporate profit hard. And when this happens, I want to invest in a business and expect that the profit is growing and I could get more dividends and possibly capital appreciation. So that's why it's important to understand valuation of businesses. Now, the bottom line is uncertainty is at all-time high, but that's where real money is made. So let's talk strategy. Here is my game plan. I'm doing two things, but like I said, this is not investment advice. This is what I'm doing, what I'm comfortable with. One, dollar cost averaging. I'm not trying to time the bottom, but I'm picking up high quality companies at a discount. And I've got an eye on Amazon, Microsoft, Meta, and Google. All solid companies with long-term growth potential, in my view. Two, I'm using option strategies. I am making money while waiting. How? Cash secured puts. I sell puts on stocks like I did today on SOFI, right? I want to own at a lower price, but I get paid for now by selling cash secured puts. I should have the cash, right, for the shares. And one option contract has 1 units, 100 units. So what that means is I should have shares to buy the 100 shares of that for one contract. Now, by so doing, I set the strike price below the current price at the price where I want to buy. It's kind of like I am writing insurance. And to say, well, if this stock drops below, let's say $10.50 in this case for SOFI, I am comfortable buying it from you, right? So I open the position by selling, and hence by selling, I get a premium, and then I close the position by buying back if I want to close the position. If the stock is up above the strike price at the close of the day of that particular option contract, it means I will still keep the premium anyway. So that's how I'm doing it. So that's one strategy that I'm using. So I keep the premium, I get to buy the stock at the price that I want ultimately to buy it, and it should have the fundamentals and it should pass the checklist for me to even consider doing that, and hence it's a win-win. Now, the bonus move, covered calls and vertical spreads. This let me generate extra income while holding on to stocks I already own. The best part, this strategy works whether the market goes up, down, or sideways, right? Particularly the covered calls. Vertical spreads, I do vertical put spreads when the market is going down. Vertical call spreads when the market is going up. When I'm bullish, I've done videos to show specifically how these strategies work. So now, what's next? Why am I excited about this opportunity? I know what you are thinking. Why are you excited when the market is tanking? Simple. One, volatility, in some cases, if you know how to look for good securities or assets to buy, creates an opportunity. Stocks don't move this much often. This is a perfect time for me for my options trading strategies that I indicated. Two, reciprocal tariffs causes market jitters. If the US and its trade partners go back and forth on tariffs, big tech stocks could tank even further. That's taking a bigger hit. But That just means better entry points for my long-term strategies. Now, 3, the Fed will likely pivot. Eventually, rates won't stay this high forever. When they drop, these same beaten down stocks will likely rocket back up. So if I'd gotten in when they had gone down, that could be a potential to make money. I'm not saying it's easy, but at least having a plan puts me ahead of 90% of traders who just panic and start selling. I'm not saying I'm a genius, but what I'm trying to do is I'm just trying to see if I can profit from this. And if the market keeps on dropping, I want that. I've got a bit of cash to buy more at lower prices, and that's how you win in the long term. If you watch the videos in the past, I've been saying this to say, look, it's always good to have, at least in my view, like 20% cash in the portfolio. And then you can then kind of like dollar cost average. And also given that the S&P 500, which tracks the 500 companies that are publicly listed from different sectors in the US, has been going up. I think in 2024, it's returned around 24%. In 2023, 24%. That usually rarely happens. It doesn't happen many years. So this year, I'm not surprised that the S&P 500 is down. It might still rebound. This is just April the 3rd. I'm recording this video. But the point is, this is an opportunity, in my view, for buying wonderful companies. Not any other business. I don't like investing in stocks that are losing, businesses that are losing money. I like businesses that are making profits, that are fundamentally strong, that are run by people who know what they are doing. You can see in terms of the returns, profit margins, and also the great products that those particular businesses will be producing or offering in case of services. So that's it for today. Streetwise fam, so that you don't miss the next breakdown, comment below, are you buying or selling or just watching the chaos? I want to hear your thoughts. Follow me also on X, Instagram, TikTok, under Streetwise Economics, and even Isaac for daily market updates. And if you want one-on-one coaching on your trading strategy, visit www.streetwiseeconomics.com to book your session with me. Until next time, stay smart, stay streetwise, and let's make some money. See you in the next video. Thank you.